Welcome back to the deep dive. Today, we're doing something that I honestly think is, well, it's one of the most effective ways to understand how the world actually functions. We aren't looking at headlines, and we certainly aren't dissecting political speeches. We are digging into a shipping report, specifically the 2025 annual review from Precious Shipping, or PSL.
It's really good to be here, and you're absolutely spot on. If you, as a listener, want to know what's really happening in the global economy, you don't stare at the stock market ticker tape all day. You look at the ocean. You look at the physical movement of goods from point A to point B.
Exactly. And this specific document, it's a total beast of a report. It covers everything from the granular cost of moving iron ore across the globe to how artificial intelligence is sort of secretly driving up thermal coal consumption. It's got trade wars, actual armed conflicts, and this mysterious economic force they're calling the Pilbara Killer.
Which sounds like a villain in a thriller novel, right?
Yeah.
But it is actually a very sober, heavily detailed financial reality check of the maritime industry.
So here is our mission for today's deep dive. We are going to unpack this thing piece by piece. We are going to look at the hard financials, every single dollar, and to see exactly how much money these massive vessels generate in a day. And then we'll shift gears into their crystal ball predictions for 2026. Because 2025, that was a highly volatile year.
It really was a tale of two halves, as the industry likes to say. The year kicked off with intense fears over tariffs and disrupted trade routes, but it actually ended with a rather surprising market rally. Though to understand the mechanics of why that happened, we really have to just dive straight into the hard data.
Let's start right there with the money. In global shipping, the ultimate currency is the US dollar. So I want to open up the audited financial results for the fourth quarter and the full year of 2025. Let's look at the daily grind. What is a single ship actually pulling in per day?
This is the absolute fundamental metric in the bulk carrier industry, earnings per ship per day. For the fourth quarter of 2025, the company's vessels were generating an average of USD 14,301 every single day.
Okay, 14 grand a day. I need some context for that figure. How does that sit within the broader historical performance?
It represents a very strong finish to the calendar year. But if you pull back and look at the entire 12 months of 2025, that average actually drops. The full year average figure came in at USD 11,948 per day.
So there is a pretty noticeable gap between how they performed across the whole year versus how they sprinted to the finish line in Q4.
Yeah, precisely. It shows serious upward momentum late in the year. However, when we benchmark the full year 2025 against the full year 2024, we do see a contraction. Back in 2024, the average earnings sat at USD 12,700 per day.
That means year over year, the daily income per vessel shrank by several $100s, which has to hurt when multiplied across a fleet of 40 ships.
Oh, it adds up incredibly fast. But here is where the volatility of the freight market becomes apparent. Shipping is never just a flat, predictable line. The report points out that the absolute highest earnings per day per ship achieved during Q4 2025 spiked all the way to USD 22,171.
Wow. So on their absolute best trading days, a ship was bringing in nearly double what the yearly average looked like.
It's wild, but that perfectly illustrates how, when the market tightens, say, demand suddenly spikes or a major transit canal gets restricted, freight rates can just skyrocket, essentially overnight.
Right. Now, bringing in revenue is one thing, but these are massive, complex industrial assets. They burn through cash just to exist. Let's pivot to the burn rate, specifically the operating costs, or OPEX.
Running a bulk carrier is an expensive endeavor. You're paying for crew wages, heavy insurance premiums, specialized lubricants, onboard stores, and constant maintenance. In the fourth quarter, the daily operating costs per ship were USD 5,503.
Let me check the target figures provided in the report. They had established an annual target of USD 5,400, so they ran a bit hot in that final quarter.
They did, overshooting the budget by a little over $100 a day.
Should investors view that as a red flag regarding cost control mechanisms?
I wouldn't rush to that conclusion. You have to investigate why that capital was deployed. A significant portion of those Q4 expenses was preparatory work for dry docking, essentially getting the ships ready for their mandatory, highly rigorous special surveys. It's similar to spending a chunk of change on your vehicle's transmission right before embarking on a cross-country drive. It's a necessary preventative capital outlay.
That makes logical sense. So Q4 was undeniably expensive. How did the cost management look over the broader 12-month period?
For the full year 2025, management actually demonstrated excellent discipline. The average daily cost settled at USD 5,338 per day.
Oh, so they actually managed to beat their own target across the entirety of the year.
Exactly. Beating that 5,400 mark is impressive, but we do need to look at the inflation narrative. In 2024, the average cost was USD 5,293.
Meaning there was a slight upward creep in daily expenses.
Yes, a marginal increase, but one that is remarkably well managed when you factor in the persistent global inflation affecting everything from spare parts to crew provisions.
All right, so with top-line revenue slightly compressed and operational costs marginally higher, we need to look at the ultimate profitability metrics. Let's break down the EBITDA and the net profit.
Starting with EBITDA earnings, before interest, taxes, depreciation, and amortization, which gives us the clearest view of raw operational cash flow. For quarter 4, that figure was USD 26.45 million.
Zooming out to the full year.
The full year 2025 EBITDA finalized at USD 69.49 million.
Let's do the year-over-year comparison on that cash flow.
It is a visible decline. The 2024 EBITDA stood at USD 82.60 million.
Which translates to a roughly double-digit million-dollar reduction in operational cash generation.
That leads us directly to the absolute bottom line, the net profit. For Q4 2025, net profit was USD 10.77 million. And for the full year 2025, the reported net profit was USD 13.09 million.
Hold on. Looking back at the historical data, the net profit in 2024 was USD 41.31 million. That is a steep, steep drop-off.
It looks incredibly severe on the surface, I completely agree. But any financial analyst will tell you the real story is buried in the adjustments. That 13.09 million figure carries a lot of accounting baggage. Specifically, exchange rate fluctuations and non-recurring items, basically weird one-off costs or paper games.
So what happens when we strip away the accounting noise?
If you isolate the core operations and look at the clean profit, the net profit excluding those anomalies for 2025 was actually USD 16.28 million.
That certainly softens the blow compared to the headline number, though it obviously still reflects the reality of a softer freight market compared to the previous year.
Correct. It was undeniably a tougher environment, but the core business remained definitively profitable.
Now, since Precious Shipping is publicly listed in Thailand, we owe it to the local shareholders to translate these realities into Thai baht. Because, as any Forex trader knows, when you switch currencies, the narrative can morph dramatically.
It absolutely morphs, primarily because the Thai baht experienced significant volatility throughout 2025. Let's look at the earnings per share, the EPS. For Q4, the EPS printed at Baht 0.23.
In the annualized figure.
The full year 2025 annual EPS was Baht 0.27.
Let's lay that next to the 2024 performance.
In 2024, the EPS was a much more robust Baht 0.94.
So investors are seeing a massive contraction in their per-share earnings power.
They are, though again applying that same clean calculation we used for the dollar figures, stripping out the foreign exchange impacts and non-recurring events, the derived EPS for 2025 calculates out to Baht 0.34.
A bit more palatable, but the trend line points downward. Let's put the raw top line and bottom line Baht numbers on the table for complete clarity.
Total revenues for 2025 registered at Baht 5,335.62 million. That represents a step down from the Baht 6,267.15 million recorded in 2024.
And the net profit conversion.
The official net profit landed at Baht 413.85 million for 2025, a steep decline from the Baht 1,468.28 million posted the prior year.
I really want to dig into the mechanics of why the baht-denominated financials look disproportionately worse than the dollar-denominated ones. The report features a very specific line item regarding a foreign exchange loss that seems to be the culprit.
It is the primary culprit, and it's vital for investors to contextualize this. The rapid appreciation of the Thai baht triggered a recorded foreign exchange loss of Baht 138.41 million.
Did the company actually lose that capital in poorly timed currency trades?
No, absolutely not. Listeners shouldn't panic about that figure. It is strictly an accounting mechanism. It's classified as an unrealized or notional loss.
Break that down into everyday terms for someone not steeped in corporate treasury operations. How do you record a massive loss without cash actually leaving the building?
Okay, think about having a long-term mortgage on a property overseas. Let's say you owe $100,000 on it, but your daily income and your personal ledger are tracked in Thai baht. If the baht suddenly strengthens dramatically against the dollar, the paper value of that foreign debt shifts when you run your monthly budget. But you aren't actually paying off the entire 30-year mortgage today.
I follow you. The liability sits on the balance sheet, its value fluctuates based on daily exchange rates, but unless the debt is being settled right this second, it's just a phantom number.
Precisely. PSL holds bond liabilities long-term debt instruments totaling Baht 1,360 million. Crucially, these bonds don't mature until 2029 and 2034. Strict accounting standards mandate that they mark the value of that debt to the current market rate, so that 138 million baht loss is merely a temporal snapshot. It doesn't impact current liquidity at all.
That provides a lot of reassurance. However, there was another line item regarding costs that did represent actual cash outflow: finance costs.
Yes, that is hard currency leaving the accounts. Finance costs increased by Baht 48.22 million year over year.
What drove that specific increase?
It's driven by their strategic fleet rejuvenation plan. They are actively taking out new loan facilities to acquire modern, eco-efficient vessels. Utilizing that leverage naturally incurs higher interest expenses.
Okay, so the operational profits faced headwinds and the cost of capital rose. But the ultimate question for retail and institutional holders is always about capital return. Did the company maintain shareholder payouts?
Despite the macroeconomic friction, the company maintained a very shareholder-friendly posture. In 2025, they executed 4 distinct dividend distributions. This included the final dividend stemming from 2024's performance, alongside interim dividends 1, 2, and 3 for the 2025 operational year.
What was the distribution rate on those?
It was entirely uniform. They distributed THB 0.10 per share for every single one of those 4 payments.
Consistent yield is always appreciated, but they took it a step further. The report details a share buyback program, which is typically interpreted as a massive vote of confidence from the C-suite.
It's the ultimate signal that management believes their own equity is undervalued. The board of directors authorized a substantial repurchase program, capping out at THB 675 million, which allowed for the potential acquisition of up to 155.9 million shares.
Did they manage to deploy the full allocation of that capital?
They deployed a very aggressive amount, though not the absolute maximum.
Right.
The final tally was the repurchase of 74,587,400 shares.
That represents a highly significant portion of the outstanding float.
It equates to 4.78% of the company's entire paid-up capital being retired from the open market. And they utilized THB 451.9 million to accomplish that.
Which mathematically increases the proportional ownership and future earnings claims for every investor who simply held on to their stock. Now, there is an incredibly fascinating section in this report. The management team ran an in-house exercise to calculate the lifetime return for day-one investors.
It perfectly illustrates the concept of compounding capital over long horizons. They calculated the internal rate of return, the IRR. If an investor had subscribed during the initial public offering all the way back in 1993 and retained those shares through September 16, 2025, utilizing a closing price of Baht 7.30, their annualized return sits at 15.65%.
Sustaining a return profile above 15% per year over a 32-year span is exceptional. It outpaces major global indices over numerous economic cycles.
It really highlights that while the maritime sector is notoriously cyclical, a well-managed operator can generate immense compounding wealth if the investor can stomach the volatility.
Before we transition away from the pure financials, we need to verify the structural integrity of the balance sheet. Let's look at the equity and asset positions.
Total shareholders' equity at the close of 2025 stood at Baht 14,981.81 million. That is compared to a position of Baht 16,863.53 million at the end of 2024.
And total assets under their control.
Total assets finalized at Baht 25,832.97 million, which is only a marginal dip from the Baht 26,208.28 million reported the previous year.
We also need to address their liquidity and access to credit. Are they over-leveraged?
Not at all. We already discussed the sustainability-linked bonds issued in 2024 for Baht 1,360 million. Looking at 2025 activity, they successfully negotiated and signed 5 new loan agreements aggregated to USD 157.95 million.
So institutional lenders are clearly comfortable extending them significant credit lines.
Very comfortable. Concurrently, the company was actively deleveraging older facilities. They prepaid or outright repaid USD 46.68 million in debt during the year. As of December 31st, 2025, they maintain undrawn loan facilities, basically committed capital they haven't needed to touch yet, totaling USD 151.23 million.
That is a tremendous amount of dry powder sitting in reserve. Okay, let's step off the corporate accounting floor and get onto the actual physical ships. Moving into part 4. Market segmentation and operational performance. Paint a picture of the physical assets PSL and operating.
The fleet is deliberately diversified. Throughout 2025, they operated an average of 40.12 vessels. When the calendar year closed out, the exact count was 40 ships.
What is the specific composition of those 40 hulls?
The breakdown is 11 Ultramax vessels, 7 Supermax, 18 Handysize, and 4 specialized cement carriers.
For our listeners who might not be maritime logistics experts, how do those classes differ functionally?
The easiest way to conceptualize it is by comparing them to commercial trucks. The handy-size ships are like your regional delivery trucks. They're incredibly versatile, feature their own onboard cranes, and can access smaller, less developed ports globally. The Ultramax vessels are the massive 18-wheelers of this specific sector, highly efficient, designed to move massive volumes of bulk commodities across transoceanic routes.
What is the aggregate carrying capacity of that combined fleet?
The total lifting capacity sits at 1,816,351 deadweight tonnage, or DWT.
And what is the average age profile of these assets?
The fleet averages 12 years of age. In the maritime world, that is considered midlife. They're fully depreciated beyond their initial capital-intensive years, but they aren't obsolete yet.
This brings us to a part of the annual report that I deeply respect for its transparency. The management team grades their own performance against global benchmark indices, and the results for 2025 highlight some significant operational friction.
It's a brutally honest self-assessment. Let's begin with the small handy-size segment. These vessels managed to earn USD 8,677 per day.
And what did the relevant market index dictate they should have been earning?
The benchmark BHSI index was sitting significantly higher at USD 11,910.
That is a glaring underperformance. By my quick math, that's almost a 30% miss.
It was an underperformance of 27.15%, to be perfectly exact.
What is the root cause of that? Is it poor chartering decisions by the commercial desk, or is there a structural issue?
It is entirely a hardware issue, not a management failure. The report explicitly clarifies that their specific small handy-size ships are technically rated about 15% below the theoretical standard ship used to calculate the index. The index assumes you're operating a state-of-the-art, hyper-efficient vessel. The PSL ships in this category are older, reliable workhorses. They burn slightly more fuel and lift slightly less cargo, so the market naturally prices them at a discount.
That context makes the variance understandable. How did the slightly larger assets fare, the large handy-size?
That narrative is much tighter. They brought in USD 11,739 per day. This resulted in a very marginal underperformance of just 1.44% against the index. Essentially, they performed exactly in line with the broader market.
Let's move up to the Supermax class.
The Supermax vessels earned USD 11,516 per day. The corresponding BSI 58 index benchmark was USD 12,241. That translates to an underperformance of 5.92%.
Did any specific sector of their fleet actually outpace the global benchmarks in 2025?
The modern Ultramax fleet was the saving grace here. They achieved earnings of USD 14,280 TRE per day.
Against an index of what?
The BSI 63 index was USD 14,275.
So they beat the global benchmark by exactly $5 a day.
It's a razor-thin outperformance of 0.04%, but it unequivocally proves that when PSL deploys modern, eco-efficient hardware, their commercial desk is perfectly capable of beating the global averages.
You touched on the age of the vessels being a drag on the small handy-size earnings, but the report dedicates a massive amount of ink to an issue categorized as technical downtime. This reads like a severe operational bottleneck.
It was unquestionably the largest drag on profitability for the entire calendar year. During 2025, 22 separate vessels were taken completely out of service to undergo dry docking and mandatory special surveys.
Taking 22 ships offline means more than half of their revenue-generating assets were parked in a shipyard at some point during the year.
Exactly. The operational disruption was immense. The average downtime equated to 17 days per vessel.
So for 17 consecutive days, a ship is burning through operating capital, paying crew wages, and generating absolutely zero top-line revenue.
Zero revenue. The management team explicitly identifies this heavy dry docking schedule as the main contributor to the lower than anticipated earnings profile for the year.
Is this an ongoing structural problem, or was 2025 just a congested year for regulatory maintenance? What does the calendar look like moving forward?
Fortunately for the balance sheet, 2025 was an anomaly regarding survey density. The outlook for 2026 normalizes significantly. They only have 11 ships scheduled for surveys. Consequently, we should anticipate a much higher volume of available earning days this coming year.
Which brings us to the forward-looking section of the deep dive, the crystal ball. We need to analyze the macroeconomic demand drivers for 2026, and we absolutely have to discuss the Pilbara Killer.
The Pilbara Killer. It is easily the most dramatic term you will find buried in a corporate shipping report.
It is incredibly evocative. For the uninitiated listener, define what this entity actually is.
It refers to the Simandu project. Simandou is a massive, remote mountain range located in the Republic of Guinea over in West Africa. Geologically, it holds the world's largest untapped reservoir of exceptionally high-grade iron ore.
And why has the industry anointed it a killer?
Because for decades, the undisputed king of the global iron ore trade has been the Pilbara region in Western Australia. That is the primary source feeding the massive steel mills in China. It is an established, relatively short maritime transit. But Simandou is finally coming online after years of infrastructure development. The report highlights a landmark moment. The very first commercial shipment sailed from Guinea on December 10, 2025, and successfully arrived in China on January 17, 2026.
Okay, so the steel mills in China are diversifying their supply chain from Australia to West Africa. From a pure commodity standpoint, I understand that, but why does a dry bulk shipping operator care so deeply about the origin of the dirt?
Because the core metric of shipping demand isn't just volume, it's distance. The industry measures demand in ton miles. You multiply the volume of cargo by the geographic distance it must travel. Let's look at the math. A round-trip voyage from Port Hedland in Australia to a discharging port in China is approximately 7,325 nautical miles.
A completely standard, highly optimized route.
Now compare that to West Africa. A round-trip voyage from Guinea to China is a staggering 22,700 nautical miles.
That represents a massive logistical shift. The physical distance is more than 3 times longer.
It is exactly 3.1 times longer in pure distance. Furthermore, because the port infrastructure in West Africa is currently less efficient than the highly automated Australian terminals, the report calculates that loading out of Simandou is 3.5 times more ton-mile intensive.
Let me try to frame this with a grounded analogy for the listener. Imagine you run a local courier business with a fleet of vans. Your drivers usually do local runs, completing 10 deliveries a day. Suddenly, your biggest client demands all deliveries go to a neighboring state. A driver can now only complete 1 run every 2 days.
That is a flawless comparison. The physical number of vans you own hasn't changed, but your operational capacity has plummeted because the assets are tied up in transit for exponentially longer periods.
Therefore, even if the global fleet of ships remains static, the effective supply of available ships collapses because a massive chunk of them are spending weeks traversing the oceans instead of turning around quickly.
Precisely. It acts as a massive vacuum on global shipping capacity. The volume projections are serious. They anticipate 20 to 40 million metric tons of ore flowing out of Simandou in 2026, scaling aggressively to 120 million metric tons by 2027.
That sheer volume must require the absolute largest vessels on the water.
It absolutely does. It is a demand bonanza for the massive Capesize vessels. But here is the critical strategic nuance. Precious Shipping does not own a single Capesize ship. They operate in the smaller vessel classes.
So how does a Capesize boom translate to increased profitability for PSL's smaller Handy and Ultramax assets?
It's a textbook example of cascading market dynamics. During weak markets, those massive Capesize ships often cannibalize cargo from the smaller sectors by splitting loads or dropping their rates. But if every Capesize hull is fully booked hauling Guinean iron ore on 40-day voyages, they vacate the smaller cargo markets. This capacity tightening at the top tier naturally pulls the charter rates up for the Ultramax and Supermax sectors from the top down.
That is fascinating. The disruption of a localized Australian monopoly creates a structural bull market for mid-sized shipping. Now, the report identifies another massive emerging demand driver that frankly caught me off guard: artificial intelligence.
It feels completely incongruous, doesn't it? The intersection of cutting-edge Silicon Valley software and heavily industrialized bulk shipping.
Connect those dots for us. When I input a complex prompt into an AI model, how does that physical action result in a bulk carrier being chartered?
It all comes down to the baseload power requirements. The report highlights a truly stunning statistic regarding computational intensity. A single ChatGPT query consumes 10 times the electrical energy of a standard Google search.
10 times the energy consumption for a single user action. That is exponential scaling.
And that energy demand is spawning massive data centers globally. These facilities require immense, uninterrupted power to operate and cool the server banks.
And when we look at the developing industrial hub specifically within China and India, what is the primary source of that baseline power generation?
Currently, it relies heavily on thermal coal.
So the narrative here is that the global artificial intelligence boom is paradoxically serving as a massive catalyst for fossil fuel consumption.
In the immediate term, absolutely. The report explicitly details how China is ramping up imports of thermal coal, specifically to fortify the power grids that support their rapidly expanding AI and electric vehicle manufacturing sectors. While the global aggregate of seaborne thermal coal exports is modeled to drop by about 5% to 945 million metric tons in 2025, the insatiable demand originating from China and India remains the critical variable. If the grid demands power, they will import the necessary commodities.
And those commodities are transported on the exact types of geared vessels that PSL operates.
Exactly. The digital revolution necessitates immense electrical power, which in turn necessitates raw materials, which ultimately necessitates maritime logistics.
We have thoroughly mapped the demand side. Let's flip the macroeconomic coin and examine the supply side. Are global shipyards flooding the market with new capacity?
This is where the bullish thesis really gains traction. The supply side is facing severe structural constraints. Net fleet growth in 2025 was incredibly anemic, coming in at a mere 3.14%.
I am looking at the forward-looking order book metrics provided in the report. For 2026, the global order book sits at 12.24% of the current active world fleet. Historically, double-digit order books usually signal an impending oversupply of vessels.
It certainly appears intimidating at first glance, but that figure exists in a vacuum. You have to contextualize it against the rapidly deteriorating age profile of the existing global fleet. We are facing what analysts term a geriatric fleet crisis.
What are the exact demographics of the world's commercial fleet right now?
Currently, 11.26% of the total global fleet is over 20 years of age, and the projections show that by the conclusion of 2029, a staggering 20.70% of the fleet will have crossed that two-decade threshold.
Having 1 out of every 5 commercial ships operating at over 20 years old seems highly problematic from an efficiency standpoint.
It is highly problematic. In this sector, a 20-year-old asset is essentially obsolete. They lack modern eco-designs, they require constant expensive maintenance, and their emission profiles are completely out of alignment with modern environmental regulations. They are prime candidates for demolition at the scrapyards.
Which means that the 12.24% order book isn't actually representing net new capacity expansion.
Precisely. The expert consensus is that the current manufacturing pipeline is barely hovering at replacement levels. The industry is merely constructing enough fresh tonnage to replace the aging, inefficient assets that must inevitably be retired. It is not an expansionary cycle.
If the underlying demand fundamentals are strengthening due to summon-due and energy needs, why aren't well-capitalized operators simply ordering more ships right now to capture future yields?
They physically cannot.
Yeah.
The global shipbuilding capacity is entirely saturated. But crucially, the shipyards are not clogged with orders for dry bulk carriers. They are operating at maximum capacity, building highly complex container ships and massive specialized gas carriers for the LNG trade.
So the dry bulk operators are essentially locked out of the manufacturing queue.
They are relegated to the absolute back of the line. If a bulk operator approaches a premier shipyard today with fully secured financing, the earliest delivery slots available are years into the future, and the required capital outlay is exorbitant.
So the physical introduction of new supply is severely bottlenecked. Furthermore, the report details how international regulators are actively degrading the efficiency of the vessels that are currently operating on the water.
The regulatory squeeze is very real. We are talking about the EEXI and CII frameworks implemented by the International Maritime Organization. To achieve compliance with these strict carbon intensity regulations, operators of older vessels are being forced to physically install engine power limits.
Which acts as a mechanical governor, permanently restricting the maximum speed the vessel can achieve.
Correct. The report quantifies the operational impact of this regulation on the PSL fleet. They suffered an average speed reduction of 1.5 knots across their vessels, strictly due to these mandated power limits.
To an outsider, a reduction of 1.5 knots sounds relatively insignificant.
In isolation, it sounds trivial. But apply that speed reduction over a 40-day trans-Pacific voyage. It cumulatively adds multiple days to the transit time. Every additional day a vessel is at sea is a day it is unavailable to accept a new cargo fixture. It is a stealth reduction in global supply.
Can we quantify that macro supply reduction?
The report calculates that the heavy concentration of special surveys functionally removed 2.2% of the geared ship supply from the market in 2025. Furthermore, the implementation of EEXI speed limits reduced the effective operating supply by an additional 3.3%.
When you combine those figures, you are looking at 5.5% of the total global fleet effectively evaporating purely due to regulatory friction and mandatory maintenance schedules.
It's a massive structural deficit. So you have a scenario where demand is being supercharged by extreme long-haul routes from Simandou and robust energy requirements, colliding directly with a global supply chain that is aging rapidly, physically constrained by shipyard capacity, and being artificially slowed down by environmental regulators. It creates a deeply asymmetric risk-to-reward profile for freight rates.
Let's expand our scope to the global geopolitical map, part 7 of our deep dive. The maritime logistics network operates directly within the crosshairs of every major global conflict.
It is arguably the most exposed commercial industry on the planet. The annual report meticulously identifies the critical vulnerabilities, the geographical choke points. You have the Malacca Straits, which process 24% of all world trade. The Straits of Hormuz handle 11%. The Suez Canal manages 9%, and the Panama Canal facilitates 3%.
And currently, significant portions of that infrastructure are functionally compromised.
The most acute crisis remains the Red Sea corridor, due to the ongoing hostile actions by Houthi forces. The corporate stance articulated in the report is uncompromising. Transiting that zone is an absolute no-go for any prudent vessel owner.
Has PSL completely suspended operations in that region?
Entirely. They operate under a very strict internal risk framework. They categorically refuse to execute voyages to any sanctioned nations, explicitly listing Russia, Venezuela, and Iran, and they have zero tolerance for Red Sea transits.
Therefore, their vessels must execute massive geographic detours to maintain trade flows.
They are forced to route vessels entirely around the African continent via the Cape of Good Hope. This diversion injects weeks of additional transit time into a voyage. Again, this compounds the ton-mile demand matrix, requiring more ships to move the same annualized volume of cargo.
There's also significant commentary regarding the Black Sea region.
Yes, the ongoing conflict between Ukraine and Russia continues to heavily disrupt agricultural exports. The report notes a sharp 25% contraction in grain exports originating from Ukraine specifically in December 2025, primarily driven by targeted attacks on port infrastructure.
I noticed a compelling term in the geopolitical notes, the shadow fleet. Explain what that signifies within the context of global sanctions.
It represents the darkest, most opaque corner of the maritime industry. As Western sanctions against entities in Russia and Iran became increasingly stringent, a vast, unregulated shadow fleet rapidly materialized.
It sounds like a rogue operation. What characterizes these vessels?
They are predominantly ancient, structurally compromised vessels operating entirely outside the standard insurance and regulatory frameworks. They frequently employ obfuscation tactics, such as deactivating their AI's transponders to mask their locations, and conducting highly dangerous ship-to-ship cargo transfers in open international waters to obscure the true origin of sanctioned commodities.
Why does a fully compliant operator like PSL highlight this illicit activity in an annual report?
Because it bifurcates the market. The shadow fleet represents an extreme environmental and navigational hazard. However, from a purely economic standpoint, these rogue vessels are absorbing the illicit dirty cargoes, thereby isolating the legitimate premium cargo market for compliant operators like PSL. It artificially constricts the supply of legal tonnage available to major multinational charterers.
We must also address the macroeconomic elephant in the room, the geopolitical dynamic between the United States and China. The return of the Trump administration implies a return to aggressive tariff regimes. Are we looking at a recreation of the 2018 trade disruptions?
The market definitely experienced an initial wave of extreme apprehension, fearing a direct replication of those historic tariff battles. However, the report highlights a recent development characterized as a localized truce. China publicly announced the procurement of 792,000 tons of U.S.-origin soybeans.
Is that interpreted as a diplomatic de-escalation tactic?
It functions as a pressure release valve. But the truly vital strategic insight detailed in the report is China's broader macro pivot. They are actively redirecting their immense export capacity away from the United States and heavily toward the global south, aggressively targeting emerging markets across Latin America and the African continent.
How does that strategic realignment impact the logistics sector?
It forces the creation of entirely novel, highly complex trade routes. Instead of the traditional, highly optimized direct transit from Shanghai to Los Angeles, the cargo is now flowing from Chinese manufacturing hubs to distribution networks in Brazil or Nigeria. These emerging routes are significantly longer and far less consolidated, And in this industry, longer distances and complex routing invariably translate into enhanced earnings potential for the asset owners.
Let's bring the focus back specifically to precious shipping's internal mechanics. Navigating this chaotic, geopolitically fractured, and heavily regulated environment requires a definitive strategy.
Moving into Part 8, Environmental Strategy and Fleet Renewal. How is management positioning the physical assets? The corporate strategy is remarkably straightforward, but highly capital-intensive. Sell the old, buy the new. They are ruthlessly upgrading the fleet's ecological footprint.
Provide the concrete data points on that execution for 2025.
Throughout the year, they successfully divested 4 older, less efficient, non-eco vessels. They excised the high-emission assets from the portfolio. Simultaneously, they took physical delivery of 3 ultra-modern, eco-design Ultramax ships. Furthermore, they aggressively expanded their future capacity by purchasing 4 new-build Ultramax hulls, scheduled for delivery across 2026 and 2027, alongside the acquisition of 2 resale Ultramax units that entered the fleet in January 2026.
That is an aggressive, highly focused modernization campaign. Does that capital expenditure translate directly into verifiable environmental metrics?
It absolutely does. The industry utilizes the Carbon Intensity Indicator, or CII, which strictly measures the volume of CO2 emitted per ton-mile of cargo transported. The consolidated average CII across the entire PSL fleet in 2025 was recorded at 6.35 grams of CO2.
Contextualize that figure. Is 6.35 considered highly efficient?
It is a solid baseline performance. However, analyzing the segmented data reveals the true impact of their renewal strategy. The older handysize segment averaged a CII of 6.24, but the newly acquired technologically advanced Ultramax fleet posted an exceptionally low CII of 4.28.
That implies the new assets are operating with nearly 30% greater carbon efficiency.
Precisely, and the long-term trend line is even more impressive. Since initiating these efficiency protocols in 2014, they have successfully driven down the carbon intensity of their handysize segment by a remarkable 59%.
And it is vital to emphasize to the listener that this aggressive decarbonization is not merely an exercise in corporate public relations. It's fundamentally about protecting the bottom line from impending taxation, correct?
It is entirely about capital preservation. The regulatory taxation regimes are already active. The European Union's emissions trading system, the EU ETS, legally mandated the purchase of carbon credits covering 70% of a vessel's emissions for voyages touching European ports in 2025.
And that coverage mandate expands moving forward.
In 2026, that mandate scales to 100% of emissions. If an operator attempts to trade an antiquated high-emission vessel into the European market, the associated carbon tax penalties will absolutely obliterate the voyage profitability. PSL's massive investment in eco-tonnage ensures they can continue accessing premium global markets without suffering catastrophic tax liabilities.
We have dissected a massive volume of data today. From the daily cash generation of USD 14,301 to the sprawling 22,700 nautical mile logistics chains originating in West Africa. Let's synthesize this into our outro. Based strictly on the report's conclusions, what is the definitive outlook for the global market in 2026?
The official macroeconomic projections remain highly cautious. Baseline global demand growth is projected at 2.0%, while global supply growth is currently modeled at 3.5%.
Let me stop you right there. If supply is projected to expand at 3.5% and demand is only expanding at 2.0%, standard economic theory dictates we are entering an oversupply scenario. Charter rates should logically compress.
Within a frictionless theoretical spreadsheet model, that assumption is correct. However, that baseline 3.5% supply expansion entirely fails to account for the compounding friction of the wildcards we've discussed. It does not factor in the massive ton-mile inflation generated by the Simandou project. It completely ignores the structural capacity loss caused by mandatory rerouting away from the Red Sea. And it fails to incorporate the compounding daily delays resulting from the mandated 1.5 knot speed reductions across the global fleet.
Meaning the theoretical gross supply might be growing, but the actual deployable effective supply is highly likely to be contracting.
That is the core thesis. The macro models project a loose market, but the physical reality on the water is demonstrating acute tightness.
So the ultimate question for investors assessing this space is, will the compounding friction of geopolitical conflict, the massive energy demands of artificial intelligence, and the logistical complexities of the Pilbara killer be powerful enough to completely absorb that theoretical supply growth?
That is the defining question for the upcoming fiscal year. However, the report's ultimate conclusion is that precious shipping has positioned itself defensively and offensively by aggressively modernizing the asset base, strictly managing their debt profile, and maintaining intense operational discipline. They are structured to remain highly competitive regardless of macro volatility.
And as the management team so accurately stated in their closing remarks, operating within the maritime logistics sector means accepting that, fundamentally, disruption is the new normal.
It is the only constant. The maritime industry offers unparalleled insight into the real-time mechanics of the global economy, provided you are willing to navigate the inherent volatility.
I think that is the perfect analytical note to conclude on. This has been a truly illuminating exploration of the physical infrastructure that powers global trade. Thank you for joining us on this deep dive into the 2025 shipping report.
It was a pleasure dissecting the data with you.
And to our listeners, I highly recommend contemplating how these hidden logistical bottlenecks might impact the consumer goods you interact with daily. We will catch you on the next deep dive.